Good afternoon. I welcome you to today's Trading Spotlight webinar, hot topic webinar, together with Admirals. It's Wednesday. It's the 22nd of June, 2022. And today we want to have a look at a topic which many of you will probably have thought about a lot, respectively are very excited to learn more about. Today we want to dig deeper into the strategies the big boys use. What do I mean by that? Well, we want to look at hedge funds in this context. We want to look here at strategies these hedge funds use in their trading. Most recently, hedge funds have seen some serious headwinds, given their also management fee / performance fee structure. And the underperformance, they've also seen while markets have presented themselves quite volatile. Some of them had trouble to make money, even though, have had trouble to make money. This is one thing, but also lost sometimes significant chunks, even though they were expected to perform at least stable during such volatile times, given that they have the opportunity to short markets. And this context will also be topic of today's webinar here. And I hope you will get some informations and some informations in regards to the strategies, and probably can use this then in your own trading to build your own small little hedge fund, in fact, given some input around strategies these big boys use. So first of all, I want to share my screen, and then let me just here check if everything's fine. I can now also see that there's also lots of participants, and let me just here write a hello traders in the chat box. This is the chat box where you can ask all your questions. If you have any, please feel free to ask them. If you watch now the recording here of this webinar on YouTube, on the YouTube channel from Admirals, please feel free to leave a thumb up here if you like what you will witness in the upcoming minutes. If you have a comment, if you have any topics you want to see us discussed, or if you have any questions around what we will dig deeper into here in the upcoming minutes, please also feel free to ask them the questions below the video, leave the comments, and so on and so forth. Subscribe to the YouTube channel, also probably something very important, so that you don't miss any of the webinars which we are recording and then streaming for you. And I think that's it around the introduction. So first of all, here the first slide, something I already mentioned, what we want to dig deeper into today before we officially start, let's say before we really jump into the action and cover today's agenda. I'd like to also introduce Admirals as a broker to you. So all the strategies which we're discussing today, well, they need plenty, let's say, of assets. You have the possibility to trade. You have to make sure that you have a broker who's also offering you opportunities to short a market, and all this can be found at Admiral Markets. So admiralmarkets.com for further information. A broker which is in the financial industry, I think for now over 20 years. I think last year with the rebranding which took place, and why we're now talking about Admirals has to do with the fact that there was the 20th anniversary. Fully regulated broker in Europe via the CISEC, in the UK via the FCA, in Australia via the ASIC. Also a new regulatory entity came into or oversees the business from Admirals now, from Jordan. If you have any information, or if you need any information about this, if you want to learn more about this new regulatory body, then also please feel free to check out the website, respectively check out the possibility here to reach out to Admirals directly, to their service desk, and ask your questions. So one broker in this context, and today it's we're talking about hedge funds and many different strategies we want to dig deeper into. First of all, certainly I'd like to introduce what a hedge fund is, what a hedge fund does. Then we want to dig deeper into long-short equity, where this comes from, in fact, the history behind this. We want to look at market neutral strategies. You probably have also seen here in the Admirals YouTube channel that there were some webinars in the past, which, for example, made so-called pairs trading a topic. And this pairs trading, to some extent, can already give you an idea on how this works and looks like in the real world. In fact, we also want to dig deeper into stuff around fixed income arbitrage. This is more sophisticated, let's say. So this is not a strategy a classic retail trader can easily adopt in his trading. Still, we want to dig deeper into this, and then we certainly also want to dig deeper into something I refer to as global macro. So when I trade, it depends a little on what asset I focus on. So if I'm trading intraday, and I'm fully focused here, then I'm fully focused on US equities, for example. And then I sometimes trade as quick as some minutes in my trades. I really know what I want to see. And then I use this information and try to sometimes really scalp into the order book, in fact. And this is my very short-term trading. But when I trade FX, for example, or when I trade stuff like precious metals, gold especially, then my time span is bigger. And even though I look into the technical picture, I dig deeper also in my overall, or I have an opinion on where we are headed right now. So right now, for example, something I mentioned to a client in the morning, that was like, what do you think will be a hot market in the upcoming weeks, probably months? And I said, well, right now you've seen plenty of turbulences in the crypto space, but I said to him, well, I think you should carefully watch what's going on in dollar JPY right now, because it looks as if the Japanese central bank, the BOJ, is losing control of its yield curve, and they have a monetary policy approach. So you see, you have to dig deeper into this and really know about the fundamental aspects. And that's one of the reasons why I love FX trading so much. This is in fact where I come from, even though my focus now shifted back to my initial roots and then US equities, because this whole game is so fascinating. It's really exciting to learn more about the fundamental drivers. And in case of in case of the JPY, and by the way, let's just, I just saw that the presentation itself is a little thin when it comes here to when it comes to pictures. So probably let's just dig one short period of time into the chart here and have a look here at dollar JPY and give you some further thoughts on where we're standing. So what you can certainly see here in the chart now is that we've seen a strong downtrend, respectively uptrend, downtrend in the JPY, uptrend in dollar JPY. The reason for this is that there is a high positive correlation between US yields in this context. Let me just see. This is now a chart or a picture I can show you. One sec, please. It's here. It's in German. And the reason why it's in German is because it's a picture which I used in my first book I wrote here in Germany. It's on Forex trading. And what I wanted to illustrate is what drivers there are in the FX space. And in this context, I made this correlation, this positive correlation between dollar JPY and 10-year US Treasury yields topic. And it's still given. So it's a book which was first published in 2014, so nearly 10 years old. But still, this correlation is still given. And back then, you can see that's why here we have July 14, why this ends there, because it was published in 2014. There was a high positive correlation. And back then, by the way, you can also see here that in yellow, it's 10-year US Treasury yields. And you see here in gray, it's dollar JPY, back then trading at 110. Now you can see we are trading here up to 136. This is, by the way, the highest level we've ever seen since 1998. And so now the question is, why is there this correlation? And the reason for that is because you have two countries which have a very similar possibility, let's say, or no, probability, that's probably a better word, to pay back debt. They're A-rated, or at least this is what I think. It's still true. I'm not really sure, but I think all of them, all of the debt here in terms of JPY debt or Japanese debt and US debt is triple A rated. And so now the question is, well, does it make a difference where to invest my money? And the answer is a clear yes, because in case of 10-year US Treasury yields, you're right now receiving more than 3%, while in Japan, you're not getting anything, or at least it was that you don't get anything. It was pegged to zero, in fact. Right now, it's 0.4, if I'm not mistaken. And so still, you can see it's more attractive to invest your money in the US, respectively in US debt, than it is to invest it in JPY. And the reason for this peg of 0.0 or at zero is in fact that there's a so-called yield curve control right now in Japan. So the Japanese government is after pegging here the short-term debts or the short-term yield to the longer-term yields, 10-year JPY, 10-year JGB, Japanese government bonds, I'm sorry, to nearly zero. And now we see spikes on the upside because what we're currently witnessing is that there's massive capital outflows from investors out of the JPY. This is the reason why dollar JPY is running so high here on the upside, while there's no real chance now for the Japanese government bond to get back yield here to 0.0 or slightly above that level, because then they have to give up really on the JPY. So now what is the global macro play, coming back to the presentation from today and why this is so fascinating? And since I expect lots of volatility to occur, we've seen it most recently in the bond market already. There was some really aggressive spikes overnight you could witness in the GB yield market here. And I think there will be an intervention. The only problem is how to intervene. How are you capable of pegging or buying bonds here to 0.0 and control the yield curve as you told investors you would do at your latest central bank meeting, while making sure that the JPY is now is not accelerating its downward spiral it currently finds itself in? And the answer is, well, you sell USD. Now you wonder, does the Japanese government, or respectively the central bank, do they have that many USD? Well, Japan is the biggest creditor of the US, in fact. So they have more bonds in their portfolio or US debt in their portfolio than the Chinese have. And you probably have witnessed, probably not sure whether that was true in the English media, but at least over here in Germany was kind of was talked about a big weapon the Chinese have when things spiral out of control from a political standpoint, and that was something many were talking about for quite a while. And now the thing is that we find out, well, the biggest creditor of US debt is Japan. And if they want to bring down dollar JPY, while they have to buy bonds back to peg the yields back at zero, well, what will they do? They will potentially aggressively sell USD. And this is a trade, global macro idea. You can see that. So you have to dig deeper into the fundamentals. But if you understand that and you look at this and you see such an extension on the upside, risk reward wise, it seems interesting to short dollar JPY at the current levels, even though timing is a big important factor, because now we're talking about leverage products here and we have to pay negative swaps overnight. So you want to see the trade come into play as quickly as possible to avoid negative swaps here on your overall account, something you have to take into account. But as you can see, so this is right now something which is very interesting and very similar to the explanation, or the same explanation I gave to the client in the morning, in fact, and where you can already get an idea on where is global macro coming into play. The other strategies are more, let's say, quantitative, like And first of all, now we have to start with what is a hedge fund. I give a short and brief overview of what a hedge fund is, but I'd like to recommend you a book. Let me just see. Can you see that? Can you see that here? Well, I hope so. A little difficult now with this. So you can see here that the book is a very catchy title, More Money Than God. It was published, I think, in 2008. Let me just see. I think so, 2010. It was published in 2010, and the author is Sebastian Molleby. More Money Than God, New York Times bestseller, a book on the history of hedge funds. Well recommended. It's really nice read, and gives you a way better overview of what hedge funds do, story behind hedge funds, how they came into existence. And it also covers shortly after the great financial crisis, how things developed back then, especially in the summer 2007 with Citadel. You probably have heard about this hedge fund, who really went bust during that time, in fact. And lots of very interesting anecdotes within the book. In our case today, we want to keep it simple and short here. So first of all, hedge funds are alternative investments, or employing alternative investment strategies, also using different strategies in this case. And what they try is to capitalize on inefficiencies here in rising and in falling markets. And what usually is very important, especially for so-called high net worth clients, the so-called NHWs here, so high net worth clients, is that these hedge funds are usually less regulated than mutual funds, for example, which means that they have a way greater universe of tradable markets, respectively, strategies, and they can also employ leverage, for example. So this is a very important aspect. And usually they have also how can I say that? Advantage that if you invest your money with a hedge fund, then what you usually find is a very tax lovely environment where these hedge funds are located. So they usually tax havens, and saving tax is also one of the aspects which plays a very important role, especially for high net worth clients in this context. Certainly, many governments around the globe want to regulate them, but still, this is definitely something to keep an eye on. By the way, also very great series. I think it's on Sky. I'm not really sure. I think so. I highly recommend watching the series Billions. It's very great. I really love the series. I think most recently they came up with their 6th season, if I'm not mistaken. And the guy who's playing a very important role there, I'm not sure about his real name, but in my world, he's Bobby Axelrod. So probably this is also something to have an idea, where you can get also an idea, even though sometimes a little, let's say, blockbuster-like, but all in all, to get an idea on how these hedge funds and their strategy usually work, and how they also try to find the ways, or look for investment opportunities here, given the overall political pressure they find themselves in, and so on and so forth. But coming back to the strategy, so what hedge funds usually tend to be is illiquid. So that means that investors who invest usually have to keep their money with them for a certain period of time, or for longer periods of time. And withdrawals are only possible at certain periods of time. So it's not possible to come in and out, which is usually then also one of the reasons why investors aim for greater returns than they get, let's say, than by investing in bonds like treasury notes, 10-year or something like that, which are highly liquid, and where you can get in and out in a trade within in fact seconds within your trading platform. And some of the most known hedge funds are Bridgewater Associates. Ray Dalio is the founder. I'm not really sure if he's still the CEO, respectively CIO CIO, but at least what I've read about, even though I didn't dig deep enough into this topic now to present you something, but I think he's heavily short European markets, if I'm not mistaken. What we certainly don't know is whether he is short Europe while he's potentially long US equities or Chinese equities in this context, and probably betting on Europe going down in the current environment we find ourselves in. Then there's also Renaissance Technologies. Jim Simons is the founder here, probably the most successful hedge fund of all time. By the way, there's also a book, respectively, I think I listened to it. It was an Audible, but there's also a big book out there. But I think the title was The Man Who Solved the Market. Yes, it's from Gregory Zuckerman, The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. In fact, this is another highly recommended book in this context to learn more about how, especially then, quant hedge funds build their portfolio. Then there's the Man Group, there's AQR Capital Management, Cliff Asness. He's also quite active, if I'm not mistaken, on Twitter. And there's also, I already mentioned it, Citadel and Ken Griffin, the guy you probably have heard about also in regards to the payment for order flow discussion with Robinhood and also HFTs in this context, so high frequency trading and so on and so forth. So all in all, a very fascinating field, let's say. But what you're probably more interested in is in different strategies. And I as I already said, I scrolled through the presentation before I started, and I was like, is it really that great without that many pictures? But more, it's like lots of text here. So certainly you can take screenshots, no problem. But I try to tell you something around this with given developments in the market, so that you get at least an idea on where to find these strategies. So a long short equity is the first strategy you want to look at, and this is the most basic one. In fact, it was the first hedge fund which came into existence, which was launched by a guy called Alfred W. Jones in 1949. And what he did was he used in his portfolio a so-called long-short equity strategy. And what's certainly interesting is that was the main idea, and that still today, till today, data shows that many hedge funds still use long-short equity strategies. And the concept behind this is in fact very simple. So what long-short equity hedge funds do is they take positions long in equities, but also on the short side based on so-called relative strength, for example. So what you can, for example, and it's very similar to the pair trading we were talking to, but also where we can employ lots of models to find out where do you expect an outperformance to happen. That's what I talked about in terms of Ray Dalio. Coming back to the most recent one, let me just see, by the way. Let me just see. I will probably open here. Ray Dalio. Let me just Ray Dalio Europe. Ray Dalio Europe, so that you have here. That's just in German. Let me just see. Ray Dalio Europe. Let's go with CNBC. Yeah, well, this is okay. So let me just scroll this over here. What do we have here? I accept. Okay, so Dalio is right to short Europe strategists say the pain will go on for quite a while. So what is his idea in this context? So what he just does is he shorts a basket of stocks, but we don't know if it's a net if it's a net short position in his overall portfolio, or if he is short a basket of European stocks while he's then long, let's say, a basket in similar areas of, for example, US stocks. So the idea behind this could be, for example, before I started the webinar, one thing which I read and probably also you came across yesterday was that Volkswagen, so the German car builder, is talking about overtaking Tesla in the EV space in or till 2025. So that's interesting. I have to admit, I don't think so. And if I'm very bullish when it comes to Tesla, for example, given the overall growth outlook. Um, and I'd belong in my portfolio a Tesla, the stock, okay? And then I'd probably say, okay, but don't be too concentrated. Probably Volkswagen is right. So probably Volkswagen has a good outlook. And I probably say, okay, I weight my portfolio, let's say 60% of the money I have, I invest in Tesla, and then I take the other 40%, I invest it in Volkswagen, given whatever reason, fundamental reasons. And then I say, okay, well, now I'm net long, but as you can see in the current environment, we are down on the year. So we are currently in a bear market. And so how can you hedge your exposure if your outlook for the, let's say, electric vehicle sector, for example, is it continues to grow? If you're, if you expect Tesla to outperform, probably to Volkswagen to also perform quite well, probably not overtaking Tesla, but still performing better than its competitors. But what do you do in an environment where you can currently see the market coming down? And then you look at other electric vehicle companies, like, for example, a Rivian, or what else? Rivian is the first one. No, I think about, for example, yeah, take the Chinese ones. We also made them a topic here, like a NIO, or like a Li, like an XPath, or XPeng in this context. So the ticker symbol is XPath. And then you say, well, I'm long these candidates where I think the growth outlook is really strong. And then I short, let's say, a Rivian, or I short also a Lucid, for example. Even though the thing with Lucid is a potential candidate to probably be overtaken, especially if someone like Apple comes into this space. So you can see it's like you really have to understand the market you're in, but given your overall fundamental outlook, you then weight your portfolio accordingly. So you hedge your longs with shorts, while you say, well, I expect these stocks to perform well, while I expect others to underperform, especially in a bearish market environment, which we probably will drift into due to a recession, whatever, but still perform solid given the bearish outperformance in the candidates I'm currently short. And then if the market turns around, Tesla, for example, is probably going to outperform on the upside again. How could this be? Well, look at, for example, the chart in Tesla. Simple look at the chart on the daily chart. You will see that Tesla was most recently, let me just see. We have a chart here. Let me just see, do I have a Tesla here? So there's a coin. There's a Tesla. So what you can see here is, for example, that we didn't make new lows. So the May lows weren't breached here on the downside, but instead we turn around now. Yesterday was a quite strong day. Let's see if this continues today with the words being used from Powell in front of the Senate Banking Committee, for example. But you can see, well, we held these lows, slightly higher lows. And now let's compare this to the overall market. Let's look at the tech sector. And what you can clearly see is we breached them. We broke lower, and we are still in a downtrend here. So this is the overall market. I haven't now viewed the electric vehicle market, but this is usually something where some traders might say, and also investors, hey guys, this is not bearish. So this is in fact something which points to relative strength. And if you come to this conclusion, then in a bearish environment, you then see that where if the market is turning around, turning bullish again, that Tesla is then starting to outperform and overtaking the bullish outperformance, or the bullish performance in these stocks where you're short at, and then generate so-called alpha in this case. So you're making money for your clients. And so the idea behind this is, again, a concept which you probably remember we talked about in the past in one of the webinars here on pairs trading, in fact, and where we talked about so-called fungible assets. And we used an example back then with two companies in the same industry, not electric vehicles, but we were talking about Coca-Cola and Pepsi, for example. And then I was giving the simple example that I said, well, you saw probably a pop on the upside in, let's say, Coca-Cola, because they're, I don't know, hiring a new, I don't know, CEO, COO, CFO, whatever, and the market considers this to be a bullish news, but still, all in all, what you would expect is that Pepsi and Coca-Cola, given their their product they're selling, well, obviously they're looking at the same market. And now if you see a gap up in one stock, you expect the other stock in the same sector and given the same business model to follow, or the stock which popped to come back. And this results then that you say, I'm shorting the stock which popped and go long the stock which didn't pop. And I expect this difference to narrow once again. So this is in fact the trade, and the idea behind such a long short equity trade, in fact. And yeah, that's it on long short equity. And the idea behind this again is over 70 years old, 1949, with a guy first and initially introducing this concept here named Alfred W. Jones. Again, also described the story and the history of hedge funds in this book I just recommended. And so now also interesting, and you can see this is like gray. It's not clear border in this context, which we can draw like a clear line. So we are talking now about market neutral strategies. This is a second quite common used strategy from hedge funds in this case. And so what you will naturally see when looking at long short equity, one where you could probably see some kind, sometimes a natural tendency that these hedge funds, so HF is short for hedge fund, they're sometimes not typically net long or net short, so they're not fully hedged. That's also something you probably came across also in the recent past. Reason for not being fully hedged is that a hedge fund in this case can say, well, overall, I expect stocks to outperform. We also had some webinars in the past where I pointed this out, that in the long run, you see that stocks perform extraordinarily well, which then means for a long short equity hedge fund that he probably says, well, I don't want to let these extra yield passing by, and that's why I'm not fully hedged, but I have a slight exposure on the long side. That was also something which could be clearly seen over the last 10 years with the massive quantitative easing taking place from the central banks, especially from the Fed in this case, and then market participants, especially investors, started to wonder, well, why do they charge 220 in this case? So what do we mean? So this is also a point which I pointed out here. 220 means that you have a management fee of 2% for the money you manage, and then you get a performance fee, so-called high watermark, but still of 20% of all the profits you make. So that means that like you have, I don't know, 100 million you invest in a hedge fund here, you have 2% per year management fee. That means that the hedge fund manager, in this case, already makes 2 million a year. Usually this is not the compensation for a good performance, but it is to keep the lights on, let's say. So you pay already as an investor 2%, 2 million in this case, if you invested 100 million management fee. And then if the investor now, the hedge fund manager, let's say makes, I don't know, let's say 20%, which is quite solid, I think, on your 100 million, then he makes 20 million, and on these 20 million, you have to pay another 20% performance fee, which then equals to another 4 million, yeah, and the 4 million you add up to the 2% management fee, and then you have to pay 6%, in fact, per year on your investment. And now you wonder, well, why do I need to pay 6% if I see that the overall strategy these hedge funds employ with not being fully hedged is very similar and highly positively correlated to, let's say, an index fund, an ETF I could easily invest in and I don't have to pay 6% for. And this is exactly something why many hedge funds were criticized in the most recent past, in fact. And so, in fact, these market neutral hedge funds now, they talk about being market neutral, which means they are really aiming to be fully hedged. So there's no overweight long, for example, but they really don't have any net market exposure and are fully hedged. And if they are not, you probably have heard about this, I've read about this in the option market, for example, when it comes to being so-called delta neutral, Sometimes you're not, and you need to dynamically hedge given the most recent developments in the market, especially if volatility picks up, for example, then that you will say, well, I have to now hedge my exposure to a given date to make sure that I'm now again delta neutral. And this is exactly what these market neutral hedge funds aim for, so that there's no net positive or net long, also net short exposure at all, in fact. And so now coming here to the latest point. So in fact, underperformance most recently, and I just saw that there was a question here from Darshan. That's why they tend to not perform super well, as otherwise the watermark goes higher, making hitting it tougher. Yes, so usually these concepts are high watermark based. So this is a very important aspect to note here. Let's assume you have a hedge fund, you invested 100 million, and then he makes 20 million. And the next year he's performing negatively, let's say -5%. You only have to pay this performance fee once you reach new equity highs. So that means if he's coming down now from 120 to, we don't look at fees now right here, and he's coming down to 115. So now he has to make 120 again, and then another, let's say 125 or something like that, coming to 125, so that then for the next 5% on top, that he has the right to get a performance fee on. So this is the high watermark concept. So he has to hit this level once again and once again and once again. So to make sure that he has the same interest of making money, and not only sit back and cross his legs and say, well, you know what, I now wait till the end of the year and then just collect the management fee and don't perform well anymore, respectively. I just try to hit 20% in 1 year with taking massive amounts of risk and then trying to make another 10% the next year, 20%, drawing down. I make back the 5% and then getting money for the 5% in the third year once again. But still, in fact, underperformance here does not come as a big surprise with stocks going up and down in unison. So right now, what we can currently witness, and this is something you've probably also seen, with the central bank invention. So it's not that it's very difficult to hedge your exposure, because most of the assets we find in our portfolio are sometimes highly positively correlated. And that's something also to keep an eye on here. And this is also with very low yields back then. So now they are picking up again, but in comparison to earlier, at least 20 years ago, it's still a low yield environment we find ourselves in. And so this is also now here making it more difficult to find the extra percentage points on the upside. So there's other ideas, for example, earnings from stock loan rebates, for example. So they can loan out stocks, for example, and get earnings for doing so, for example, given their lots assets under management they have themselves in respect of the big portfolios they're managing, and this is other ways to earn money for their clients, in fact, but it's very difficult in a low yield environment. So right now we are picking up here. On the other hand, investors rather sooner or later will say, well, we are still not fine with 10% because inflation is 10%. We'd really like to see our account grow by 15-20%. The good thing about higher yields in this context is that usually this goes hand in hand with higher volatility. So this is also something worth mentioning in this context. And so finally, or not finally, there's another strategy, but I talked about it quite in depth already. But let's have a look here at fixed income arbitrage. And what's meant by this? So fixed income arbitrage hedge funds usually work with high leverage to eke out returns from so-called risk-free government bonds. If they are risk-free or not, well, we will find out quite soon, I think, given my overall global macro picture. But what happens here is that, in fact, hedge fund managers here make leverage bets on how the shape of the yield curve will change. An example, if the hedge fund manager expects, for example, long rates to rise relative to short rates, then what they do is they are betting on the yield curve to steepen. So longer, they expect inflation to pick up, for example, steep yield curve. And then what he does is he goes short bonds with longer maturity, respectively bond futures, and buys bonds with shorter maturity in this case. And these hedge funds came under scrutiny not last year. I'm sorry, that wasn't last year, but it was in September. It was in not last year. It was in September 2019. It was in September 2019, when volatility in repo market increased massively. So we've probably seen that. That was before the Corona pandemic, and there was now developments taking place which needed the help, in fact, of the U.S. government, or not the government, but in fact the central bank, the Fed, and to intervene here. But also we could see massive and sharp rises here, for example, in 2020 in March, with massive volatility picking up here during the Corona lockdown. And what happened there? Let me just, for example, go back here into the chart, and let me just go to $JPY again, because there's this high positive correlation. And let me just scroll back here a little. So that was here. I'm not really sure if that's such a good idea to have a look here. Probably not. Is there another opportunity? What can I do? What can I do? Doesn't really matter. So why is it of interest here in this context? So the spike lower, in fact, even though you can't really see it now, well, we could also say, well, there was a strong and high demand for US dollar back then, given the aspect that a US dollar is the yields, I'm sorry, not the yield, but the world reserve currency #1. What's of more interest is the developments we could see here in bond markets. And what we've seen is that the gap, in fact, here between government bonds, which were traded in the spot market, and those which were traded in the future market, it rose to a level that it became even interesting from a potential advantage side, or from a return side, for, let's call them, more conservative and unleveraged hedge funds here, to say, well, we dump our exposure in government, in corporate bonds, and we now go into the cash future fixed income market to try to trade the difference between these yields, and to profit from the current large gap we find ourselves. And even with no leverage being employed from our end, we can still make a lot of money. And the problem with that was that we've seen a complete dry up when it came to corporate bonds, which added to the risk of these companies to go bankrupt, in fact, back then. And that's also something to keep in mind, and where these arbitrage models, respectively, these fixed income hedge funds here, come into play. So there's lots of very interesting developments, in fact, in this market. And again, right now, what we currently witness, if you understand what's happening there, you will understand in depth and in more detail why it's so important right now to have a close look at $JPY. So I could imagine, given, I'm not sure how long you're in the market right now, but I've been around already when the S&P gave up their 120 pack in Euro Swiss franc in 2015 in January. And I was right in the action back then. So I really was working with a company, and in a company, in fact, which was highly and highly leveraged in a bet here, and nearly went bankrupt. And in fact, went close to out of business back then, respectively, was taken over then from a Wall Street boutique here, and then they had to bail them out, in fact. And so given that is definitely something to keep an eye on, and to keep this in mind brings us to some extent right straight away into this global macro approach. I already introduced it at the beginning. I hope you have an idea now on this. Here on the slide, I'm referring to the bet from George Soros here, where he tried to break, or where he broke, in fact, the Bank of England. That was back in 1992. You've probably heard about this, read about this, and the bet against the pound sterling. And in this context, now you probably wonder, why do I focus on dollar JPY? The reason for that is because it's still one of the most liquid currency pairs. And if really, that's put it simply, the shit hits the fan and really liquidity is drying up, you will still find a way to enter and exit trades accordingly and based on a solid risk money management plan when you trade the most liquid currency pairs like dollar JPY, for example. And that's the reason why I focus on these. And that's also an approach which is used, even though I'm not trading billions of USD, but still one of the approaches I use in my trading, and hedge funds do so as well, given the massive amounts of money they are turning over and trading the markets. And what's very important in this context is that here, that the global macro hedge funds are not necessarily hedged. So in fact, they quite often make big directional bets here. And as a result, you will see that these global macro hedge funds don't have consistent and steady returns. In fact, their equity curves are quite volatile compared to other hedge fund strategies, but the returns usually are outstandingly positive and good once they hit. So this is like we could come down to saying like they swing the bet hard if they smell or see an opportunity, which is very positively skewed risk reward ratio, and they can capitalize on, in fact. And so that's it on the strategies from hedge funds. I hope you enjoyed this. So short, quick summary. So hedge funds are alternative investments using different strategies, trying to capitalize on inefficiencies here in rising and falling markets. And one of the reasons high net worth clients are looking for them and invest their money with them, and they have to come with big amounts of money, in fact, to be accepted as clients, is that they are usually less regulated than mutual funds. Thus, they have a far bigger universe of tradable markets and strategies, also employing leverage, but also in addition to that, are also very interesting sometimes from a tax perspective, in fact. And so some of the most commonly used hedge fund strategies we learned more about today was long short equity, the classic, market neutral, given that long short equity is not necessarily fully hedged, but there's a slight overhang sometimes on the long side, most likely on the long side. We also learned something about fixed income arbitrage and my personal favorite, global macro. I just hope that you enjoyed this webinar as much as I had fun presenting it to you. So contact Admiral Markets if you have any further questions. Check out the website, admiralmarkets.com. Also, leave a comment in the chat box if you watch the recording on YouTube. Subscribe to the YouTube channel. Also, leave a thumb up here if you like the webinar. And fully regulated broker, very important here. Please read carefully. There's risk involved when trading. So also, please feel free again to reach out if there's any further questions. That's it for me. So I wish you all the best. Happy trading. Watch your stops and keep an eye on dollar JPY. We'll listen. Respectively, I'll be here again on Friday. I really look forward to it. All the best. See you. Bye-bye.